joint venture deals. And today we're going to talk about one of my favorite topics, which is seller financing, and specifically why now is the time to learn how to do this, and why in particular overseas clients are hungering for these types of deals. We have been doing deals with overseas clients for the last decade, and never has the timing been better for these kinds of deals. So we're going to talk about that now. Just to be clear, and I want to make sure that I set expectations up front, this is not going to be a training session, a detailed training session on how to do seller financing deals. There's no way in the world I can get that done in an hour and 45 minutes. What this is going to be is an understanding of why you need to learn how to do seller finance deals. And we're going to go in detail on a seller finance deals, actually a couple, so that you get an understanding of how they work. But there's no way that I can get into the technical details and the paperwork and the structure. So don't even worry about trying to catch all that. I just want you to get the gist of what I'm presenting so that you can understand why this thing is so ridiculously powerful. It is easily one of the most powerful approaches, strategies in the real estate investor's arsenal. And once you understand this, you'll be able to do deals that other people can't do. And we'll talk about that in a minute. But first, there is a little bit of housekeeping since this is a working call, and I've opened this call up for the public, but for the Team Unstoppable folks, this is their regularly scheduled call. So there's a little bit of housekeeping that we need to do. I'll be brief. Because I don't think we're going to have hundreds of people here, here's how we're going to handle questions. If it's a burning question that you have to get answered right when I'm talking, by all means, unmute yourself, ask the question, and I'll try to answer it. If I think it's something that I can wait, I may ask you to wait, but I don't want you to lose it. And it's a small enough group here that we can interactive. Yeah, I'm sorry. Somewhat interactive. However, there is going to be time set aside for Q&A. So I'm going to ask that if you can hold on to your questions, thanks Daniel, that you hold them until we get to the Q&A part if you think you won't lose it. So that's how we're going to handle that. So let's talk now just briefly about some housekeeping. It's going to be real fast. I just want to remind those people who are in Team Unstoppable that are doing joint venture deals with me that if you want to do deals with me, there is a call, there's a link that I'm going to put up on the screen for you to access that lets you set up those calls, one-on-one calls with me. So we'll talk about that in a second. Then we're going to get into how the U.S. looks to an overseas investor. I think that's important. We're going to spend a little bit of time on that because it's something that we don't think about a lot as U.S. investors. We think that the whole world operates the way we do, and that's just not true. And then we're going to talk about why seller financing is magic to an overseas investor. Then we're going to have Q&A, and then we're going to move on. So let's talk real fast about that housekeeping issue that I mentioned before. And this is it. If you are looking to schedule a one-on-one call with me to talk about a deal that you're working, or to talk about strategy, approaching sellers, then this is how you do it. You go to bit.ly/team unstoppable schedule call. The T, the U, the S, and the C need to be capitalized. And if you go to that site, I'm not going to go here now, but if you go there, it explains exactly what I'd like you to do. It means going into the shared area that you and I have on Google Drive, creating a subdirectory, putting some things in there so that I can prepare myself for the call. I don't want to get on these calls and have to review all the stuff in real time. I'd rather be able to do all that stuff in advance. So my request is that you go to this link if you want to schedule a call, read the fairly detailed instructions that I provide on that page, and then follow those instructions to set up a one-on-one call. And then I will happily meet you at that time on Zoom, and we can talk about your deal or your seller or sellers, and we can try to drive to a conclusion that benefits you and benefits me. Just to be very, very clear, and I've said this before, but I'll say it again, you are not bothering me when you schedule these calls. These calls are what I'm doing. I'm doing joint venture deals with my investor community. which is the Team Unstoppable folks. So don't be hesitant to reach out to me if you've got a hot lead that you want to work. In fact, if you have a hot lead, don't even wait to do a Zoom call. Contact me and we'll talk about it. But if you want to schedule a time for us to do a one-on-one, don't feel like you have to do that once in a blue moon. Do it when you need it, because this is what I'm carving out time to do. This is my joy. This is what I want to do. I want to get us all doing more deals. And that can't happen unless you have access to me and I have the ability to help you get over your hurdle. So I just wanted to throw that out there real fast so that everybody that is on Team Unstoppable understands that that is a benefit of being on the team, and it is not in any way bothering me. It is, for those of you who've done these before, you know, I could talk about this stuff all day, and I kind of do. So, gotten that out of the way, let's transition now into the mode of the topic of the evening, which is seller financing. And I want for a minute for you to expand your view. I mean, we talk in this country a lot about real estate and rentals and houses and such. And we often forget that the way we do things here is not the way things are done everywhere. Ours is a fairly unique society. The United States values home ownership, for example. And so we have things like VA and FHA and USDA, that programs that encourage people and support people and help people qualify for mortgages. That's just not true worldwide, and that has some major implications. But let's take this minute or two. I want to talk about currency exchange. I want us to take a little trip around the world real briefly in the context of currency. We have, of course, in the United States, our currency is the dollar. No big deal. We, of course, understand, most of us, not all of us, that dollars aren't used everywhere. In fact, they're pretty much only used, or they're only the official currency of the United States and its controlled entities. So consider the European Union. Their currency is the euro. If you had, at the beginning of this year, 100,000 euros sitting, let's just say for now, sitting in a zero interest account in Europe, anywhere in Europe, you pick where, on January 1st, 2022, this year, you had 100,000 euros. Well, the exchange rate on January 1st for euros, and you can verify all this stuff on a website called z.com, xe.com. It's a currency exchange website. 100 euros at 1.14 exchange rate means for every dollar you get 1.14, sorry, for every euro you get $1.14. That means 100,000 euros is $114,000. Pretty straightforward. However, a couple of weeks ago, if you had taken that same pile of euros, 100,000, and tried to exchange it for dollars, you discovered on January 18th, for example, that the rate was 1.05. So the number of dollars that your 100,000 euros would have bought you is $105,000. What that means is from January 1st to June 18th, compared to the dollar, the euro lost 7.89% of its spending power. You were 7.89% poorer if you had kept your money sitting in euros from January 1st to June 18th. And I'm going to give a couple more examples of this, but the challenge here, I mean, I thought about putting more graphics and pictures in my presentation. I am an engineer, so you get what you get. But you know, if I could have put a picture here, it would be of some screaming European person complaining about the fact that they just lost 7.89% of their money. Now, did someone come and grab that and take that off of the table? No, the 100,000 euros is still sitting there in an account or on the table. It's just that it buys 7.89% less in dollars than it did in January. And that's not good, right? You don't want to be losing buying power ever. You want your money to be making money, not losing money. And that's just in 6 months. So we'll talk about that in a minute, but I want to run through a couple more of these because I want you to feel the pain around the world, because we sometimes insulate ourselves from what's going on in the larger world. And yes, you know, we're probably facing a recession in the United States, but the saying is, when the United States sneezes or catches cold, the rest of the world catches pneumonia and dies. So as bad as it is here, it's going to be even worse in other places. So continuing on with my example, in China, 100,000 of their currency, which is either yuan or renminbi, is on January 1st. The exchange rate was 0.157. That means it would have bought you 100,000 yuan, would have bought you 15,700 US dollars. On June 18th, that would have bought you 14,900. So they lost 5%. Not as bad as Europe for a variety of reasons, but the thing to keep in mind is it's still a loss, right? If you're a Chinese businessman and you have, or woman, and you have $100,000 in the account on January 1st, on January 18th, you lost real money. Your spending power is greatly diminished in the 6-month period. Let's pick it up. This is one of my favorites, Argentina. Their currency is the peso, the Argentine peso. 100,000 Argentine pesos only buys you $900 on January 1st. The Argentina has been getting crushed by inflation. But even worse, on June 18th, that would have bought you $800 worth of, $800 would be 100,000 pesos. So you would have lost $100 off of 900. That's an 11% drop from January 1st to June 18th. So if you're an Argentine business person and you're collecting pesos every month, well, every 6 months, in this case, in the last 6 months, you lost 11% of the spending power of your money. That's a real problem. That is not just an, oh, that's not pleasant. That's, again, if I had a picture here, it'd be of a screaming Argentinian citizen going, I just lost 11% of my money. Not pleasant. Canada, 100,000 Canadian dollars on January 1st would have bought you 79,100 US dollars. January 18th would have bought you 76,800, only 2.91. So Canada didn't fare too badly. The Canadian dollar didn't fare too badly compared to the US dollar, but still a loss. Still a loss, right? Australia, also they use dollars, Australian dollars. 100,000 of those on January 1st would have been 72,700 US dollars. On January 18th, sorry, on June 18th, that would have been 69, or 4.54% drop. The thing to keep in mind is all of these were drops. All of these were negative. At no point did any of these currencies allow the people who held funds in those currencies to gain. They all lost. What that means is that these folks, some more than others, right? Argentina, maybe the European Union, some of these countries more than others, are really, 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 really eager to find ways to stop this bleeding, because this is interesting for us here in the United States. This is real money for people who are operating in these other countries. This is a real blow. This is a loss of spending power, of the ability to buy goods and services. So this is not just, I mean, it's numbers on a paper, on a screen for us. It is reality in these countries, and it's painful. I also want to point out a couple of things. These example calculations are only for 6 months. So that 11%, for example, for Argentina, that's just for 6 months out of the year. If that continues, that's a 22% drop over the course of a year. That's ugly, that's hideous. And we'll talk about Argentina in a minute, but just be mindful of that fact that if the rate continued, if the drop continued from January 1st through June on to December, then those numbers would be twice as bad as they are now. So the 5s would be 10s, the 7s would be 14s, ugly. Also, just keep in mind that these calculations completely ignore US inflation. So what we also know what's happening right now in the US is prices are going up. So not only are these other currencies losing ground compared to the dollar, but they're also facing the headwind of 8% of inflation, which means that prices have gone up effectively across the board, 8%. So not only are they losing spending power because their currency is not faring well, they're also losing spending power because things are becoming more expensive in the United States. So you can actually, in some cases, add those in. So if it's 3% currency loss and 8% annual inflation, then effectively it's like an 11% negative outcome percentage-wise for them. So all that to simply say bad stuff for foreign investors. And that explains, at very least, why so many investors from outside of the US are desperately trying to do deals here in the United States, because finding investments that they can do, that they can get into, that crank out US dollars means that they can beat that issue. As long as they're generating money in their home currency, they're going to be facing the situation. If they buy real estate, if an Argentine citizen buys real estate in Argentina, the rents that they're getting paid are in pesos. The pesos, they don't want pesos. They want something that's going to hold up better over time. So they need to generate dollars. The people in Argentina aren't paying their rent in dollars, they're paying them in pesos. If they want to find places where people are paying rent in dollars, they're coming here. And that's why foreign investors can't get enough of the United States market, especially now when the Fed is raising rates. I'm not going to get too deep into that, but I want to present to you the scenario that we're dealing with, because a lot of investors don't look at this. And honestly, before 10 years ago, I didn't look at this either. I kind of just focused on my own little market. We were in Atlanta. I focused on Atlanta. But when I started talking to investors from outside of the US, I realized that there's this whole enormous world out there that is desperately trying to get deals in the US, and I didn't understand why. And then I started looking at the numbers and I realized, that's why, because they're getting clobbered in their native currencies. I want to continue this real briefly. I want you to see Argentina. I'm going to pick on Argentina because you need to see it. You need to understand what it looks like. So hopefully you all can see this. Can you all see this chart? Okay. This is the chart. This is the 1-year chart for Argentina. That's where it started out a year ago. That's where it is now. And this is the spending power of the peso. This is what the Argentine peso can buy in terms of dollars. And you can see right there, that's about a dime. Well, that's about a penny. That's $0.01, which is a penny, right? So they were at a penny a year ago. Now they're at 7/10 of a penny. That's 1 year. Take a look at the 2-year. That's a penny and a half, right about there, and that's where it is now. Take a look at the 5-year. That's about 6 cents, and that was in 2017. So from 6 cents to less than a penny in 5 years. Here's the 10-year. That's about 22 cents. So in 2012, and again, it's not funny, it's tragic. In 2022, an Argentine peso was worth about 22 cents. Now that same Argentine peso is worth less than a penny. So imagine all your quarters turn to less than a penny over the span of 10 years. That's not a good day. I mean, as I tell people, it's like watching your paper currency turn into toilet paper before your very eyes. It's terrifying. And so if you were living in Argentina, you would love to be able to get your money out of Argentina into a US investment and start earning in dollars, not in pesos. There's a variety of reasons why they can't, but that's a whole different story. So I wanted just to cover that, because that's how the United States looks to the world, and we don't often talk. In fact, we rarely talk about that. We focus on our own situation, and gas is expensive, and this is expensive, and that's all true. But consider what it's like for the rest of the world looking in on us. This is what they see. This is why they're flocking here in droves. So, what's an overseas investor to do? They want US rental property that creates quality cash flow in dollars. They don't want pesos. They don't want Canadian dollars. They don't want Australian dollars. They want US dollars, because if they get anything else other than US dollars, they're losing money because their currency is sliding compared to the dollar. Now, will that last forever? Who knows? But there are a variety of reasons that I don't have time to get onto here as to why we are trying to keep the dollar strong. And for the record, raising interest rates is part of what does that. So we're going to have, at least for the time being, a strong dollar. Strong dollar means other currencies are going to be looking to the dollar longingly and trying to create investments or obtain investments in dollars. And that's good for us real estate investors, because that means we're going to have tons of people trying to do deals with us if we will let them. Here's the problem. Many foreign banks won't lend on US real estate. I mean, you live in Australia and you want to buy a rental property in Dallas, Texas, good luck. You're not going to find too many Australian banks that are expert enough or comfortable enough to lend you money to buy that property in Dallas. Just like you have a hard time getting a US bank to help you buy a property in Australia. It's just a different market and they don't have that expertise. So that's one problem. The other problem is, as I said, these folks, overseas investors, they're not US citizens. They don't qualify for FHA or VA or USDA or any of those other programs. And so those low interest, easy qualifying programs, they don't have access to those. They're typically buying cash. And when there are non-citizen mortgage options, they're often expensive. I talked to an overseas, or actually not overseas, actually she was Canadian, mortgage broker a couple of days ago, and she can qualify folks for loans, overseas investors for loans, but she's looking for 30 to 35% down, which is not, I mean, it's better than 100% down, right? But that's a lot. I mean, the norm here in the United States for a conventional loan is 20%. FHA is 3.5%. Very few Americans would be able to buy a house if they had to put 30 to 35% down. But that's what a foreign national would need to put down to qualify for one of these loans that they can get because they're not US citizens. And even then, they're not necessarily going to get the great rates that we are comfortable with and familiar with and that we can routinely get with FHA and VA, 4%, 5%. They're not getting those. So for a variety of reasons, we have overseas investors who want to own real estate in the United States for all the reasons I just described, but these are the obstacles that stand in their way. This is why it's challenging for them to buy here, because if they're buying, they're almost certainly buying cash, which is fine, but that means they have zero leverage. If the property costs $100,000, they've got to plunk down $100,000 plus closing costs, plus repair costs. And as we all know, that's expensive. That's why we all typically get mortgages. So the opportunity here, the huge opportunity here, is to offer these folks seller financing. And I want to just briefly, for those of you who, we'll do some examples, but I just want to be clear. What we're talking about is seller financing. I define seller financing as any arrangement where the seller is prepared to accept anything other than all of their equity at closing. So if they're selling the house for $100,000 and they expect $100,000 at closing, then they're getting no financing. You're paying them all of what they asked for. They owe $100,000. I'm sorry, they say it's worth $100,000. You agree to pay $100,000. You're paying it all at closing. That's not seller financing. If they accept anything other than all of their money up front, then that's financing. That's by definition financing. They're allowing you to pay some portion of the equity that would normally be paid at closing over some period of time. How long, how much, is there interest? All those things are factors, but let's keep this really, really, really simple, because it can get people can make this very complicated, and it doesn't need to be. The question you need to ask yourself is there any obligation to the seller to pay them anything post-closing? The answer is no. If they got all their money at closing, then they're done. You never have to see them again. They never have to see you again. Transaction's over. If they were supposed to be paid 100,000 and you only paid them 10, then you still owe them 90. And so the question is, well, how are you going to pay that remaining 90? And how you pay that remaining 90, and the fact that they even accepted 10 up front, that how you structure that, that's seller financing. And there are an infinite number of ways you can structure that. So there is no, people ask, well, what's the standard for seller financing? There is no standard. It's what the seller and the buyer agree to. But it's all seller financing. If they're not getting all their equity at the time of closing, then whatever they're owed post-closing, that's a financing arrangement. It could simply be, I want $90,000 10 years from now, just pay me the whole $90,000 in a lump sum, no interest. That's still seller financing. They ask for 10 down and 90,000 paid the following way. 10 years, there's a balloon payment of 90,000 bucks. That's seller financing. If they said, I want payments every month, that's seller financing. If I want payments every quarter, so we can get, there are an infinite number of variables here, but I don't want you to lose sight of what's really going on. So let's do an example. Let's walk through this. But before I do this, I just have to point this out, because this is, I guess, the critical piece here that, well, two critical pieces that don't get discussed often. The first thing is, you are here to hear me talk about seller financing because at least it's a thing. Here in the United States, you may not have ever done a seller financing deal before, but it exists. Otherwise, you wouldn't be here, or you'd be asked, this call would be full of people going, is that even possible? You know that it's doable. You just don't know, many of you don't know how to do it. That's not the challenge of people who aren't in the United States. As far as I can tell, everybody that I've spoken to who's not in the US, almost to a person, has said, we don't have that in my country. I remember talking to a lady from France several years ago. I was telling her about, oh, well, maybe the seller will take back financing, and she said, wait a minute, what are you talking about? I'm like, seller financing. And she's like, what do you mean seller financing? And I explained to her what that was, and she's like, we don't have that in my country. Most countries, in fact, I have yet to find another country other than the United States where it's common, or at least conceivable practice. I won't say it's common, but at least you've heard probably, if you're on this call, of somebody doing seller financing. Most people that I talk to who are not United States citizens, when I start talking about seller financing, their eyes get wide and they go, I had no idea that was even possible. And that's common. That's pretty much routine. So the first thing I will say is you can assume that they do not have seller financing where they're from. And that's, once they understand what it does and what it means, they go crazy, because it's like you've just opened up this brand new universe that they never explored before. And so that's one, that is huge, because just talking about seller financing will capture people's attention, because they don't have this where they are. This is not a thing anyplace else other than the United States, as far as I can tell. So that's one. And the other thing is just where we are right now in the world, or specifically in the United States, with respect to our economy and the demographics. And I've said this to some of you before. If you're on Team Unstoppable, you've heard me say this before. We are hitting the big bulge of baby boomers, right? Those born from 1946 to 1964. I am born in 64, so I'm the youngest baby boomer, and I'll be 58 in 2 weeks. So this year I'll be 58. So from 58 to 78, that cohort, roughly speaking, of baby boomers has been working its way through the population forever, for the last 50 some odd years. And now we're hitting a point where many of us are in their 60s and 70s, and they're ready to retire. And many of those people hold real estate, and they are thinking to themselves, I don't want to be a landlord anymore. I want to sit on the beach and not have tenants call me and not have to deal with toilets and issues. And many of those folks who are landlords are looking for ways to get off of that hamster wheel of working hard. And so for those folks, seller financing represents one of the best solutions for them to, instead of being a landlord, instead be the bank. We're going to talk in a minute about how that works. So those two dynamics, the rest of the world, for the most part, doesn't know what seller financing can do, or that it's even a thing. And B, here in the United States, there's this massive generation of folks who are hitting retirement age plus, who are looking for alternatives, for solutions to being a landlord. And they are ripe, they are perfect for seller financing deals. And one of the reasons for that is, if someone has $1 million portfolio in real estate and they're ready to retire, and you don't do seller financing, which, just to remind you, means that they get all their equity at closing. That means at closing, they get $1 million. Okay, great. You now have $1 million. What do you do with it? Do you put it in a bank earning 0.1% or whatever banks are paying these days? God forbid you put it in the stock market. I didn't see what it did today. I thought it was all red. So, and lose a ton of your money. Do you put it in Bitcoin? I don't think so. I mean, what do you do with it? If it's got to last you for the next 10, 20 years, and you don't want to work for it, you don't want to put it into rental real estate because you don't want to be a landlord anymore. Pay taxes, exactly. We won't even get to the tax part. That's a whole different story. You make a good point that, yes, they're going to have to pay taxes on that big old $1 million. But even after they get the proceeds after they pay taxes, where do they put it? How do they earn money? How do they live that money's got to last them the rest of their lives? And they'd like to be able to earn a decent return. Seller financing can do that for them. Few other options can. People are terrified of the stock market. So far the Dow is down, I don't know how many percent over the year for 2022. So people aren't rushing to put their money there. There's a lot of uncertainty. And at this time, for many of those folks, the best option by far is seller financing. So let's walk through an example. First, I want to talk about the all cash purchase scenario, because we're all familiar with that one. Let's say there's a property, $100,000 purchase price. Let's say renovations plus closing costs equal $10,000. Just indulge me. Let's assume market rent is about $1,300 a month, which works out to be $15,600 a year. And the total operating expenses for the year are $6,000. For those of you playing at home, that means net operating income, which is the income minus the operating expenses, is $9,600. And let's assume that at least for this first year, my cap expense budget is included in the renovation. So I'm making all my capital expenditures, capital improvements as part of that renovation money. Starts at $10,000. So that means and I'm buying cash. So net operating income minus debt service minus CapEx equals cash flow. Well, if debt service is zero, because I'm not borrowing, and if CapEx is zero, then NOI and cash flow are one and the same, $9,600. Okay, that means my cash on cash return is my $9,600 divided by my all-in. My all-in is my $100,000 in purchase price plus my $10,000 in renovations and closing costs. That means my cash on cash return is 8.72%. Not the worst deal I've ever seen, but okay, just okay. Take that exact same scenario, but let's invoke seller financing. Same purchase price, but now we're gonna, instead of paying it all down, we're gonna pay them 20% down, which is $20,000. Same renovations, it's the same house, so it needs the same renovations, got the same closing costs. Rent is the same, $15,600. Operating expense the same. NOI is the same, right? But cash flow is not, right? Because now we do have debt service. CapEx we're still including in the renovation budget, but now there's a cost to service this balance. I just realized that my calculations are off. Okay, so So there's a typo in here, and I can fix it. But so my debt service is going to be at 6%, is not going to be $6,000. It's going to be 40. It's going to be $4,800, right? Because my balance is not 100, Mitch. It's actually 80, right? I bought it for 100, but I put 20 down, so my remaining balance is 80, and I'm only paying interest on the remaining balance. So yes, so this is it. But so for those of you playing along at home, you can tell me what the actual number is. But so my debt service is slightly lower than 6,000. It's actually 4,800. 6% times 80,000. So my cash flow is actually better than 3,600 because I'm deducting less than the 6K that I have here. And I could run the numbers. In fact, let's just do that. Unless someone wants to tell me, wants to yell out the answer. I'm open to that. But if not, I'll do the math. 0.06. Yeah, 4,800.
It was 40, yeah, it was 4,800.
Oh yeah, because it's half. Okay. So the cash flow is actually 4,800, and that means, so I can do this math. So the cash on cash return is actually 4,800 divided by 30,000, which is 16%, folks. Why? Because I'm only putting in 20,000 plus my same 10,000 before of renovations and closing costs. So my all-in is the down payment plus the renovations and closing costs. And I'm making 4,800 bucks. So 16%, which is, I think we can all agree, better than 8.72. So can we all see that for the exact same deal, the exact same price, I just did wonderful things. Now, did I cut my cash flow? Yes, my cash flow is half. But I mean, that's true, but my return is way better because I'm putting in way less money. I'm not putting in $100,000. I'm putting in $20,000 plus the renovation and closing costs. So I'm doing cartwheels from this deal. And if you can, and if at the same time that I'm doing this deal, my seller is happy. Now, in order for the seller to be really happy, add an extra zero to everything I just said, right? Make it $1 million, make it $200,000, just add a zero across the board. And the savings to the seller is a lot more significant because that $1 million taxable event in 2022 is gonna have an impact. But my point is, I want to make sure that this kind of sinks in. I don't want to rush this because I want you all to see that from this scenario to that scenario, all I did was test to see if the seller would be willing to accept a $20,000 down payment and payments of 6%. Now, I said interest only. Just for the record, for those of you who know how I structure deals, when I'm talking to the seller, I don't structure interest only. Because if you do interest only, at some point you're going to have to make a balloon payment. I actually structure seller financing principal only. So I'll say, hey, what if we pay you, $4,800 over the course of the year, such that the principal goes down by 4,800 bucks every month. Every dollar we pay you reduces the principal by that same amount. Does that sound like a reasonable thing? And they go, yeah. I've just bought myself, say it with me, a 0% loan. That's because I'm not paying interest. If every dollar I pay, it goes straight towards principal, there's no room for interest. There is no interest. If after the first payment, after the first year, if I only owe 74, because again, remember the balance was 80. So if I pay, oh no, it's not yet. It's not 6 point. It's 80 minus 4.8. So 75.2. So after the first year, it's 75.2. At the second year, it's 71 point whatever. And it just keeps going down like that for 10 years, let's just say, and then we pay a balloon at the end of that. Then for that 10-year period, On that $80,000, I'm paying no interest. So and if I'm putting a tenant in this thing, if I'm buying this property to throw a tenant in there, as I am, right, because I'm collecting $1,300 a month in rent, then I'm creating equity at the rate at which I'm paying off this debt. I'm getting 4.8 or $4,800 in equity. I don't care about what the market is doing. My tenant is paying off $4,800 of my debt to the seller every year. That's not a bad deal. That's an awesome deal. So, and after 10 years, that's, by my calculation, $48,000. So, does this make sense to people? Just somebody give me I can't see your hand. I guess there's a way for you guys to raise your hands. If there's a way to raise your hands, raise your hands. Or if you just give me a, yeah, I get it. That sounds interesting.
Making sense here.
Okay. So this is, so the question obviously is, well, how do you do this? And as I said up front, there's no way in the world that I can teach the intricacies of doing this. But I will tell you this, people ask me all the time, because I think I've said this to many of you here. We've been investing, Monique and I have bbeen investing since 1999. And we have done well in excess, somewhere between, I think we calculated between 10 and 20 million. I don't even know how much it is, maybe more than that, I don't know. But it was like 10 million by 2007, 6 to 10 million right around there. So by then, since then it's gotten bigger. But the point that I'm making is, in all of our time investing, we have never gone to a bank to qualify for financing to buy investment property. Every deal we've ever done has either been seller finance or private lender. And most of them, the vast majority, have been seller finance. So when people talking about going out and getting a loan to buy investment property, I scratch my head and I go, well, I guess that's the way to go, but that is not my norm. We have never done that. That is not my go-to thing. And so dealing with FHA and how many can you have, and can you have more than 4? I don't know. I have no idea, because that's not how I acquire real estate. I acquire real estate using these techniques because there's no limit to how many of these you can do. So my recommendation is, and now, can you do seller financing on every seller? No, some sellers absolutely want all their money right now. If the seller is in their 20s and they're trying to build their real estate empire and they need all their money from this property to go buy their next property, then seller financing is probably not an option for them, because they need all their equity at closing, which means seller financing isn't an option. But if they are retiring, if they're not going to be using all that money to roll into another deal, then seller financing is a real possibility. And the answer to the question, how do you find seller financing deals, is very simple. You don't find seller finance deals. If you read about a seller finance deal being offered, that's an investor trying to sell you a seller finance deal. Owner occupants, regular people, don't sell their house to seller finance because they don't know how to do it. So seller financing comes about when we as investors ask my favorite question, which is, again, those of you who've heard me say this before know what's coming. I will typically say this in a joking manner. Let's say they have $1 million portfolio. I go, wow, you're selling this whole thing for $1 million. What are you going to do with that $1 million? You're going to go buy a yacht? You're going to buy your own island in the Bahamas? And they'll chuckle. And then if I'm quiet enough, they'll typically give me an answer. Oh, I'm going to travel the world. Oh, I'm going to give it all to my grandkids. Oh, I'm going to buy a Ferrari. But more often than not, it'll be, oh, I don't really have any plans for it. I just want to go sit on a beach in Florida and relax for a little bit. And I'm thinking, you don't need $1 million to go sit on a beach in Florida and relax for a little bit, unless you have very expensive tastes in alcohol and whatever else you need to spend that money on. You need a whole lot less money to sit on the beach. So if you're going to sit on a beach, how about you sit on a beach with $100,000 and a note for the balance, rather than sitting on a beach with $1 million sitting in the bank that's earning you next to nothing. So I will make the suggestion, would it help you and for those of you taking notes, I would write this down. Would it help you, Mr. Seller, if we talked about ways that you could perhaps save on your taxes and receive your equity as payments over time, as opposed to getting it all up front in a way that's going to probably hurt you come tax time? Would it help you to hear about alternatives like that? Would it help you if I made you an offer that might introduce that possibility? And I will almost always make two offers. I'll make a cash offer and I'll make a terms offer, seller finance offer. Terms and seller finance for me are the same thing, because all seller finance deals have terms. The terms are how long, how much, what interest rate, if any. All those things are the terms. So I call that a terms deal, but it's the same thing. So for me, seller finance and terms are the same thing. So cash offer, terms offer. Because, and I typically want them to take the terms offer. So I'll typically make the cash offer lower, less appealing, because I want them to take the cash. And I can offer, and we'll talk about that in a minute, I can offer a higher price. You can see it here. If I wanted to equalize these two returns, if I thought that 8.72 is sufficient, then I can actually pay more. I can have a higher purchase price on this deal and a higher, actually, for the record, the purchase price doesn't impact this at all. All that impacts this number is the $20,000 down. So if I made this 150 purchase price, as long as I still only had to put 20,000 down, wouldn't change my cash on cash return at all. It'll change my payoff, but it won't change my cash on cash return. And I may not care about the payoff if I'm holding this for 10 years. I may assume that over 10 years, I'll be okay if I have to pay up, have a slightly higher payoff. So my point is just that you have the opportunity now, for those of you who hadn't seen this before, you can't unsee this, right? You may not know how to do it, but at least now you know how it works and that it is possible. Not only is it possible, there are people out there who are doing nothing but these kinds of deals. And now is the perfect, and I capitalize P on the perfect time to learn how to do this, because so many people out there are in a position to do this. The estimate that I'm hearing is 11,000 baby boomers are hitting 65 in the United States every day. Now, they're not all landlords, right? But that's just a boatload of people getting older. Good question. So Ed asks, do I recommend a good book? I recommend a great course, and it's not mine. I don't have a course on seller finance. And I will, let's see, I will talk about that later because I don't want people to feel that there's a plug. So let's make sure, one or two things will happen. Either I'll answer that question at the end in Q&A, or I'll answer that question to those of you who want to hear an answer after the call. I'll say, email me. No, this is not Pace. I am aware of Pace, but this has nothing to do with him. There are plenty of folks who, I didn't learn seller financing from Pace. My seller financing training precedes Pace. The people that I learned it from were doing this in the 70s and 80s, and they're the old guys who, the Pete Fortunatos and well, anyway. So yeah, let me, but let's be clear. I didn't, they didn't, none of these people that I'm talking about invented seller financing. So you don't have to, no one's claiming that this is, math that only I know about. You don't need to, there's no special sauce here that only one person's got. This is just basic math. Now, the mechanics of these deals is where things get kind of interesting, but nothing that I'm saying here can't be applied in pretty much any market in the United States. You close just like you normally would. There's some extra paperwork that you have to, or some specialized paperwork that you have to have. But from the attorney standpoint, closing a seller finance deal and closing a deal that involves a lender, a bank, let's say, is the same thing. The lender is a lender, whether it's a bank or the seller. The paperwork is alarmingly simple, or similar, not simple, but similar. So you don't have to be an expert any more than you have to be an expert in regular closing documents to close a regular deal. You just have to find a attorney or title company that understands how seller financing works, They exist everywhere, and get it done. And as you move into different kinds of deals, you'll find this becoming a bit more common in lower end commercial, in the tens and the fours and the eights plexes. You see some of this from time to time, but it's not foreign. It's not like if you present this to an attorney, he'll say, "Oh, you can't do that." This is easily doable. We've done it in Georgia. I'm looking to do it in Oklahoma soon. It's a thing, and it's not a particularly complicated thing. But I'll hold off on the training because I want to make sure that everybody gets the big picture concept, because this stuff, once you understand it and once you're comfortable talking about it with sellers, then it opens up a whole new world. Just as a pro tip, you will never, ever hear me talk. If you do, you can smack me upside the head. Talk to a seller and say, have the words come out of my mouth, "Hey, Mr. Seller, would you be interested in doing seller financing?" No, ever. No, that's a big no, because A, that sounds scary, and B, they don't really know what that means. So I don't use the word seller financing when I'm talking to sellers. What I ask the seller is, if I paid you a reasonable amount down, and then I paid you every month, quarter, whatever, a reasonable amount per, let's just say, month, until paid in full, would that be of value to you? Would that be of interest to you? Is that something that you might consider? And then we'll walk through the numbers, and I'll happily show them a schedule of payments and how that impacts the balance and so forth. I'm not trying to hide anything, because we're going to have to close. At some point, they're going to have to be fully disclosed what's going on. But if you start the conversation off talking about, "I want to do a seller finance deal with you, Mr. Seller," almost every seller that I know is going to shut down, because that's scary to them. They don't really know what you're talking about, and nobody wants to feel like you know way more than they do. And so the answer is going to be no. What I instead ask, and I'll say it again, is I try to find out what their plans are for the money in as polite a way as I can. I can ask them, "So what are you gonna do with the money?" I mean, I could ask, but I'm not gonna get the kind of answer I want. So I'll typically make a joke out of it, but I'll try to get them to tell me what their plans are. Because some people have really cool plans. "Oh, I'm gonna buy a boat." "Oh, what kind of boat are you gonna buy? And where are you gonna sail? And what kind of sailing do you do?" I'm genuinely curious, but what I'm listening for is, I don't really have plans. I just want to be done with landlording. And this money has to last my wife and I for the rest of our lives. So I want to make sure that I can sock this away and make sure that we're generating a decent return. Well, if that's what you need, how about we talk about a solution that might pay you $6,000 a year or $4,800 a year or whatever they need. If I can structure it in a way that pays them what they need. And incidentally, the reason why I like landlords is because what have they been doing for the last 20 years? Collecting rents. They've been collecting an income stream over time. So all I'm saying is, instead of collecting an income stream that you have to go fight with tenants for every single month, how about you collect an income stream where, in places like Georgia and Texas and Oklahoma, the minute I stop paying you, you don't have to go evict me or call me up and say, "Where's my money?" You just start filing the foreclosure paperwork. And in Georgia, a month and change, you get your property back. You get to keep my $20,000. You get to keep any improvements I made to the property. You get to keep all the money I paid you up till now, and I lose control of the property. And now you own it. And if there's a tenant in there, they're paying you, and you make more money if I default than if I paid you. So you hope I would default on this thing. So it's an easy sell in those places, because if I default as the holder, as the receiver of financing, the person who has that note actually makes more money than if I paid them on time. And so it's an easy thing to calm their nerves. Can't do this in California. Well, can't. I wouldn't do this in California. I wouldn't do this in New York, because in those places, they're not lender friendly, which means the seller is in a bad spot if I stop paying. They got to foreclose. Foreclosure can take forever in California and New York. And so it's a hard sell, because if they ask the question, "What if you don't pay me?" I got to tell them the truth. If I don't pay you, then you're screwed. Whereas in Georgia, if I don't pay them, I'm screwed, because I lose that in like a month, and it's relatively cheap to file foreclosure in Georgia. We've done it. So, so hopefully that gives, we'll talk, I'm going to actually talk about an actual live situation in a few minutes, but I want to lay this out because when you can structure this deal, we all here in the United States go, oh, that's pretty cool. But what we haven't talked about is what this means. The purpose of this presentation is to talk about what this means to the overseas folks. So let's talk about that. First of all, these things close way faster than bank finance deals. So even if the overseas investor could get a bank to be willing to finance them at 30% or at 35% or whatever, it's going to take, like, I think right now they're talking 40, 45 days to close the deal. Seller finance deal, as long as buyer and seller are in agreement and the title comes back clear, close that puppy. There's no reason to delay. There's no committee. There's no, running around trying to get this thing done. You get it done. There's no junk fees. There's no application fee. I'm not paying the seller to apply for them to take back a portion of or to hold off on taking back a portion of their equity. I'm just offering to ask if they'll do it. If they say yes, then I just present them with an offer that has the terms that I want. I'm not applying for it. They're not a bank. We're not getting an appraisal because we both agree what the property is worth. They think it's worth 100,000. I think it's worth 100,000. There's no need for an appraisal. They're not a bank. All the junk fees that banks charge, most of which are not refundable if you can't get the financing, gone. Also gone is there's no credit check, right? Because, I mean, again, as I said before, if we're operating in Georgia, when I'm offering seller financing to people from Georgia, I wish they would default on me. I don't care what their credit score is. I don't need a credit score because the minute they default, they get a courtesy call, and then I start filing my foreclosure paperwork, and I get to take that property back, keep their down. I mean, again, literally, I wish that they would default. They would not. I wish they would default more than they do. So all those junk fees gone.
Question though, Mitch.
Yes.
Do you get title insurance on the properties?
Yep. I get everything that I get as a lender. I get a lender's title policy, or if I'm buying from the seller, they get a lender's title policy. And I pay for it, just like a bank would. I put them in the same position as if they were Wells Fargo. So everything that Wells Fargo gets, they get. So they get title insurance, lender title insurance. They get. We do a full-blown title search. I mean, we do everything that we would normally do with a regular lender. I treat them exactly like a regular lender because I want to protect them, and I don't want them because I want this thing to last until it's done. I don't want there to be any issues because I'm getting wonderful financing. I don't need to cut corners. So I'll happily pay that. 3 is a big one. And I think I see this all the time on the various forums. People go, oh, why would I pay this seller financing when I can get a bank loan for the same amount, same interest rate? And the answer is because when you sign that bank loan, if you look very carefully at the paperwork that you sign, you are always signing a personal guarantee on that debt. Personal. In addition to the equity, in addition to the property being pledged, you are pledging yourself and all your assets for that mortgage. I don't like that. I'm not a big fan of that. And again, as you know, as I've said, we don't do that because we don't deal with banks. When we do seller financing, these are what are called non-recourse loan, which means if I do default on the loan, the worst thing they can do to me is take the property back. And that's bad, but that's not nearly as bad as take the property back and then go reach into my pocket if they don't get fully made whole. So if they get the property back and there's a $30,000 shortage between what's owed and what they can actually get, they got to suck it up with a non-recourse loan. When you sign a mortgage with Wells Fargo, if there's a $30,000 gap, Wells Fargo can go after you personally and seize your assets to make them whole. That's what a personal guarantee does. So this exact same loan, seller finance, same interest rate, same term, same everything, same amortization period is absolutely not the same as that same loan with the same terms, seller finance. Because the seller finance loan, if it's non-recourse, gives you, I won't say it's a get out of jail free card, but at least it doesn't tie all your assets up into every single mortgage that you get. That's huge, and it's not discussed a lot. A lot of people go out and get bank loans and they don't realize that they are personally pledging all their assets on every single loan that they get. That's why lenders don't let you, generally speaking, they don't let you lend in an LLC because they don't want to have an LLC on the hook. They want a person, they want a natural person whose assets they can go after on the hook. That's why they will make you sign personally. They make you take it out of the LLC, close the loan, then put it back in the LLC if you want to, because they want you on the hook personally for that debt. So that's a big one, not talked about a lot. You can imagine why, because banks finance the majority of deals out there. And then lastly, and this is relevant for a lot of folks, especially folks who are starting to do commercial, because a lot of lenders, when you start to look at larger amounts, they build into the, I mean, if you're doing $1 million loan, the bank sets that up with the expectation that they're going to collect that interest over some reasonable period of time. And if you pay that off prematurely, in some cases less than 5 years or less than 3 years, the bank will actually charge you a penalty, a prepayment penalty for paying it off too soon. Well, we don't structure seller financing that has prepayment penalties, at least not between us and the seller. So we'll tell the seller, hey, look, we're going to pay this off in 10 years. We're going to do a balloon payment in 10 years. We're going to make payments every month for the next 10 years. And then at the end of the 10th year, we're going to pay the balance off in full. We can pay it off anytime we want to. And when we do, whatever the balance is at that time, that's what you get. That's completely fair. So that we don't build in prepayment penalties when we're structuring seller financing. And at the risk of throwing too much at you at once, I will just say that represents another way to make money here. Because let's say you agree, the seller agreed to a 10-year payment plan, 10-year term. Let's say in year 10, you come into a sizable chunk of money. You go to the seller and say, look, I want to pay this thing off, but I've got 2 more years to go and I can wait the 2 more years, but I'll pay it off now if you'll give me, Mr. Seller, a discount on the balance. I know I owe you, the schedule says I owe you this, but since I'm paying you 2 years early, if you want your money now, I'll pay it, but I want a discount off of what I owe you. You don't have to pay it, but then we'll just wait for another 2 years for it to pay off in full. And many sellers will go, you know what, I'd like to get my money 2 years early, and I'm prepared to take a little bit of a haircut to get it 2 years early. And if they say that, and we had that happen a year and a half ago on 2 properties that were seller financed, and they said, yeah, bring it on. We'll happily give you a discount. I think it generated like $12,000 each, 12 and 13. It's like $25,000 total on the 2 deals just for asking, because we were paying them back early and asking for the discount. And they said, sure, because we want our money now. We don't want to wait 2 more years. And so we carved out $25,000 and they were happy to get it. It wasn't like we cheated them, because they could have very easily said, we'll just wait until it's done. But they decided not to wait. So that's another little pro tip, just a throwaway out there. But for those of you who have done these deals before, you know that's, if you're counting, that's 4 different ways that you can get paid on these deals. But let's, I want to get to an actual deal. And this is actual as in, I'm working on this like literally right now. And this, I think, will demonstrate for you, this full screen, the power of financing. So this is, I want to show you, so this is it's a property, it's a multifamily. The seller is asking $1 million. Okay. This is my analysis of cash flow and cash on cash return. It's what I use. Let's make this a little bit bigger. Yeah, oh, well, that's a little bit too big. That's good enough. Okay, so ignore the B2C. Let's focus on the A to B. So this is between myself and the seller. I can't pay $1 million. If I paid $1 million, so that you see what it looks like. If I pay $1 million, cash on cash return is under 5%, with the assumptions that I'm putting in, which are conservative but not ridiculous. The cash flow is nice. Well, the cash flow is $4,000, but at $1 million, you would expect a pretty decent cash flow. But percentage-wise, in terms of the amount of money that I'm putting in, my return sucks. 4.95%. I can do better pretty much any place in the United States that I am currently investing in. So I would not do this deal at $1 million. I can't pay $1 million. What can I pay? Well, I like to make about 10% cash on cash. So how far would I have to go to get to 10%? I think we decided it was like 4,500. Sorry, 450,000. Yeah, 450 gets me about 10.72, so maybe a little bit less than that. But my point is way, way, way less than the seller wants. And if I go to the seller at 450, they are going to predictably throw up all over my little deal, or my little offer at least. They're not gonna do that at 450. And they're digging in their heels, insisting that they must have $1 million. And what most investors do is this. They come at them at 450, and then they're shocked and dismayed and discouraged that the seller doesn't want to talk to them anymore and kicks them out of the door and says, don't ever call me again. Because that's a pretty big drop from $1 million, right? I'm not most investors, and you won't be most investors anymore after you see what's possible. What if instead we stop fighting with the seller on the price and give them their price? You want $1 million? You got $1 million. We can write a contract up tomorrow, $1 million purchase price. But I get to set the terms. And here are my terms. $100,000 down. Everything else is exactly the same as before. If you weren't sure, my expense ratio is 34.09. It's still 34.09. So that hasn't changed. Nothing has changed, I assure you, except that instead of paying cash, I'm paying $100,000 down. That means I've got $900,000 left, and I'm going to pay that at $1,500 a month. For now, let's just say until paid in full. Now, the truth of the matter is, whether this is all principal, all interest, or some combination doesn't matter, because for the purposes of my calculation, it doesn't change my numbers, because I got to pay this out of my pocket. So it's coming out of my cash, out of my my net operating income to make my cash flow, whether it's all interest, all principal, or something in between. So it doesn't matter. I don't have to decide right now. I don't have to guarantee that I get this principal only or interest only or amortization. It doesn't matter. $1,500 is going to have to come out of my pocket and go into their pocket every month. But if I pay $1,500 a month, I mean, are y'all seeing that? 26.74% cash on cash return. Why? Because I'm putting $100,000 plus 20,000 repairs plus 2,000 in closing costs. I'm in it for $122,000 compared to whatever it was before, $500,000 or $450,000 to get to 10%. To get to 10%. So if the seller, why is this relevant? Because the seller gets to win. I get to draft a purchase and sale agreement that says $1 million on that top line. And here's how we're going to pay it. $100,000 at closing and $1,500 a month until paid in full, or 10 years to come up, whichever happens first. And we know it's not going to get paid off in 10 years. So 10 years from now, we'll pay a balloon. But in the meantime, I'm making incredibly insane cash on cash return because I'm putting very little money into this deal and I'm getting $2,700 a month in cash flow. Now, compared to before, just so that you see it, my cash flow is less, right? Because I had $4,200, but I got to pay now $1,500 in debt service, so it's going to be less. But could I live with $2,700 when I'm only out $122,000? Heck to the yeah! Give me 100 of these deals. And if you're taking this deal and And if you're making this available to a foreign investor, and I'll talk a little bit about that in a second, then you have the ability to present, to get a seller finance deal from your seller, and then turn around and make it available to your overseas investor as a wholesale transaction. Now, again, I'm going to cover the highlights of this. There's no way in the world that I can cover this in detail. I don't have that kind of time. But I'm going to introduce the word, don't freak out, wraparound mortgage. So a wraparound mortgage is to a mortgage what a sandwich lease is to a lease. With a sandwich lease or sublease, I'm leasing from Mary for $1,000. And I turn around and I sublease that to Joe for $1,200. And then I get to collect that $200 in the middle. So Joe pays me $1,200. I take that $1,200, $1,000 of it I peel off and pay Mary, because I promised her I'd pay her $1,000. And that $200 in the middle, in theory at least, I get to keep myself. Cool. But that's all rental. I'm renting from Mary, Joe's renting from me. Shift that to, shift that to mortgages. In this case, I'm getting a mortgage. I'm getting financing from the seller to the tune of $100,000 down and $1,500 a month. And then I'm turning around and I'm taking that deal and I'm selling it to my investor as a wholesale transaction. And that's what this thing at the bottom here is. So I'm buying it for $1 million, $100,000 down, $1,500 a month. I'm wrapping that financing and then turning around and selling it to the investor for $1,150,000, so $1.15 million. So slight uptick in price, $150,000, not 100, and $2,500 a month. You go, wow, that's a lot of money. Yeah, but they're borrowing $1 million. Or you're letting them borrow, you're financing $1 million of their purchase. And that $2,500 works out to be 2.6% annual. Could you sell an investor? I mean, you'd be their new best friend if you sold an investor a deal that let them get 2.6% financing. Although for the record, this is going to be interest only, but you don't care. The point is, they're going to pay you every month $2,500. You're going to take that $2,500 and you're going to pay the seller $1,500 of it. That means $1,000 of it stays in your pocket. At closing, you're going to collect $150,000 down. You're going to pay $100 of that to the seller because you promised to pay them $100. That means there's $50,000 left over that gets to be yours to keep. So you make money at closing, and the difference between the two down payments. You make money each month on the difference between the payment that you're getting from the investor, the overseas investor, and the payment that you're making to the seller. And at the end, 10 years from now, when you have to cash this thing off, if you did what I told you to do and only got an interest, got a principal pay down note on with the seller, then this $90,000 that you of balance is going to be reduced by $180,000 because $1,500 is 18,000 a year over the course of 10 years. That's 1,500 is 18,000 a year, which is 180,000 over 10 years. That means you'll owe the seller $720,000 in 10 years as a balloon payment. But guess what? This person is only paying interest only. That means they're going to owe $1 million on the day of closing. And 10 years from now, they're going to still owe $1 million because this 2,500 is just paying interest. There's no principal pay down. So you're going to get paid in 10 years, the spread between the $1 million and the 780, which by my calculation is 220. I get that right? So you're getting paid 3 times. First at closing, the difference between the down payments. Second each month, the difference between the monthly payments. And then third at the end, if you are making payments that are principal only and you're receiving payments that are interest only, the difference between the balance that's owed you versus the balance that you owe. And I might add that in this transaction, I am not a landlord. I am a lender. When I wrap this financing and make it available to my investor, I'm becoming the bank. I'm wrapping the financing that I was given by the seller. That's why it's called a wraparound. I'm wrapping that financing that they gave me in my own financing, and I'm offering it to the investor at a higher price for a higher monthly. And when it cashes off, I've got the obligation of cashing off my underlying debt. But I'm okay with that because I'm not getting called for toilets and tenants. I have no tenants. The person who's buying this from me, they've got tenants. They're going to find tenants and put those in the property, and they're going to deal with those tenants. I'm not getting any calls from anybody. And if they stop paying me at any point, I'm not evicting them. I'm foreclosing on the owner that I sold this thing to. And for the record, I'm keeping their $150,000. I'm keeping the $20,000 in repairs that they made. I'm keeping all the money that they paid me for as long as they paid it to me. And I'm going to go out and find some, and I'm going to collect the rents from those tenants until I can find another person to sell this property to that's already got tenants in it and I'm going to keep this person whole throughout all of that. And again, in Georgia, I can get that done in a month and change. So maybe for 1 month, I pay this $1,500 without having to get a payment from the investor, but I'm okay with that. Okay, so I threw a whole lot at you, and I hope I didn't lose everybody here and that you don't hate my guts. Let me pause because this was a lot, and I realized it, and I kind of went through it quickly. But does anyone have any questions about anything that I've said?
I have a question, Mitch.
Okay, go for it.
Right. This is not on what you said, but in the process of what you said, right?
Okay.
When it is that you do the seller financing, right? I understand in some states there is basically for them to secure the property, right? In terms of who actually owns the property at what point in time, there's some sort of sub deed that is done for the persons who are involved. So, for instance, at what point does the owner then give the deed over to you? And what point does the owner no longer like? How does that deeding process go in some states?
Yeah, so
well,
I'll
at least
cover
in the states that are doing that.
Yeah, I'll cover it at a very, very high level, and I'll use Georgia as an example because we've done this in Georgia many, many times. As you all know, or you might not know, when we're doing a wholesale transaction, we always, well, okay, I think one time in 22 years we didn't, but almost always double close. So this is going to be 2 completely separate and distinct transactions. So on the A to B between myself and the seller is the A, I'm the B, I'm buying their property for $1 million, and the terms are $100,000 down. And again, I wouldn't say down to them, but $100,000 down and $1,500 a month. So what's going to happen is at that closing, they're going to bring their deed. I'm going to bring my $100,000, let's just say, and I'm going to walk out of that closing with their deed, with a new deed made out to me or my entity. So I'm going to get that deed at the time of closing. And in exchange, what they're going to get is they're going to get my $100,000, plus they're going to get a note, a first position note on that, just like Wells Fargo would get on that property for the balance, $900,000. And they're going to get, they're going to get a note that explains the terms. They're also going to get a security deed, is what they use in Georgia, or deed of trust. In some states they call it a mortgage, but they're going to get a security interest against the property for using the property as collateral to secure that $900,000 loan. And they're going to get a note, a private note between them and me that I sign that pledges to pay them on the terms that we agreed to, $1,500 a month for 10 years until the year 10, and then a balloon payment at the end of that 10 years. So at the end of that closing, they've got a security deed and a note. I've got the deed. I then step to the other room of my attorney's office and I do the B2C closing. And in that closing, the investor has brought to the table $150,000 in down payment, and I've still got the deed in my hand. I now surrender that deed to the investor. So they get the deed at that closing. I instead now I create this wraparound financing I'm talking about, which is actually a secured interest. It actually shows up, technically speaking, as a second, although it's not really a second, it's really wrapping the first, but they got to call it, it's recorded after the first, so I guess by definition, it is a second lien on the property. But it has special language in it that says this security deed includes, by definition, this other security deed for, in this case, $900,000. So it kind of connects those two. And there's standard language. Again, I didn't invent any of this. Any attorney that knows how to do wrap will be able to do it for you. But that will be recorded on public record, protecting my interests. So I'll show up as the second lien holder, and I will be the one that's offering financing to my investors. So they'll owe me, they'll sign a note to my benefit, promising to pay $2,500 a month for the next 10 years, to pay it in, at interest only until the 10th year, at which point they'll pay make a balloon payment and pay me off. But they will get, at the end of that transaction, end of that B2C closing, they will have in their hands, well, the attorney actually will have it and will actually record it, but they will have effectively a deed in their name. So the deed will actually transfer to them. In the old days, we used to do something called an agreement for deed, and it was complicated and it was messy. We don't do those anymore because it's just not worth it. It's not worth the hassle. So we actually give them the deed because we don't care. In Georgia, we're secured effectively wrapping a first. So I don't need any more security than that. If they don't pay me, I'm going to spring into action and foreclose. So I'm going to protect that first interest myself, because the minute they stop paying me is when I'm going to spring into action. So I don't need any more protection than that. Georgia is a very lender-friendly state. Being in the second position, in this case, actually it's a wrap, but being in the wrap position is a strong position to be in. That's all I need. I don't need anything else. I don't need to have any piece of the deed. I don't need to mess or fiddle with the deed. I can give them a standard regular deed that's not weird or partial or any sort of asterisk. It's a legitimate deed. And I become a legitimate lender. And so now I'm sitting back waiting for them to make that very first payment 30 days from now of $2,500. And I send them instructions on how to, get the money to my account and how to pay my loan processor or whatever. But I'm getting paid. And when I get paid that $2,500, just like before, I peel off $1,500, pay it to the seller, so they're happy. I keep the $1,000 in the middle, so I'm happy. And we do that for the next 10 years until it's time to do the balloon payment, or until the investor comes to me and says, hey, I want to refinance this now, in which case I say, great. I go back to the seller and say, hey, we're looking to refinance early. Can we get a discount? But that's a whole different story. But does that make sense? I mean, at a high level, at least, does that make sense?
Yeah, it does.
Okay, just for the record, I didn't cover this before, but I should point out, if I were to keep this deal for myself, I'd get 26.74%. But if I don't keep it for myself, if I instead make it available to my investor, perhaps my overseas investor, this thing flies off the shelf. In fact, I've got people lining up for a deal like this because 12% cash on cash return, $1,700, and you've only got to put in 150 plus 20. We'll talk about that 22 in a second. That's what, 192? Is that right?
Yeah.
So instead of plunking down 1.15 million, they're plunking down 200,000. But oh, by the way, if this property appreciates, does the appreciation have anything to do with how much they put down? No, appreciation's on the value. So if it appreciates 5%, is that $50,000? Does it matter how much I paid down? If the value of the property is, now you may argue the value is not 1.15, but that's a different discussion. But my point is, this will appreciate or not appreciate based on the value of the property, not based on how much I put down. So I'm controlling $1 million worth of real estate for $200,000, and I'm getting $1,700 a month in cash flow. Not I should say the investor. I'm the investor. I'm getting all that, and I'm making 12% on my cash. Am I happy? And the answer is heck to the yeah, I'm happy. I'm delighted. Now, would they have been happier with 26.74? Yeah, but you know, if I give them that, I make nothing, right? So I want to make some money out of this deal. So if I'm the one that's wrapping this financing and making it available, I'm getting paid the $50,000 up front. Oh, and oh, by the way, let's cover this now. When you offer financing, and I know we're getting close, so I'm going to make sure, yeah, it's almost 7:30. I'm going to give you 15 minutes for Q&A, so I'm going to go back to that. When you offer financing, sorry, let me rephrase that. When you're offered financing in the real world from a bank, what does the bank collect from you? They collect points, right? Points are a thing. You don't get loans without points. At least rarely do you get loans without points. And 3 points is actually common. I'm being generous here and only asking 2 points. So this is 22,000 because 20 of this is points, which you can translate to profit. So I'm making at closing actually, not just, and I have 48 here because it's actually, when I do these transactions, I pay the closing costs for the seller. So it would be 50 because that's the difference between the 2 down payments, but I'm paying their closing costs. So it's actually 48. But I'm also picking up another $20,000 in points because the points on a significantly sized loan is considerable. And they should be happy to pay them because they pay them. If they wouldn't got financing from Wells Fargo, they'd pay points. So why shouldn't they pay me points? They'll happily pay points. So that means I'm getting nearly, no, I'm not getting nearly, I'm getting over $70,000 or just about $70,000 up front on the day of closing on a deal that I'm not even having to rent out. I'm just the bank. Then I get another $1,000 a month, every month. And then on the back end, we said 200 and plus, 220, I think we said on the back end. And that's if I don't refinance this off early, in which case I can maybe even get more money. So you can appreciate why I love seller financing. But again, I want you to remember that from the perspective of the investor, this deal doesn't make, I didn't even show you what this would look like on the B2C because you can't, this deal doesn't make sense. I mean, it makes sense at 450, but the seller's never going to go for 450. So that at the 750 that they wanted, I can't sell this to anybody else because there's no room. It's a crappy deal to me. It's only going to be crappier to somebody else. So as a cash deal, this doesn't work. As a finance deal, this does work. And if I can let an investor, an overseas investor, get into this deal for $200,000, I am their new best friend. And they will buy as many of these from me as I can sell them, which is, of course, my goal. So it's a whole lot of words. And I do need to wrap up because I don't want to keep you guys here all night. So let me get back to my, let's get rid of this. Let's go back here. And so let me pause and ask if anyone else has any questions, comments, concerns regarding this concept or anything else that I've said, because I know I covered a lot, but I'm happy to answer any questions in the 13 minutes we have left.
I have a question.
Yes.
Okay.
Is that Daniel?
I know that when you, yeah, I know that when you're loaning money to people, there's Dodd-Frank Act.
Yep.
So I want to know whether this will apply to the foreign buyers.
That's a great question.
That's one question. Yeah, that's one question.
Let me answer that question. So Dodd-Frank is a pain in the butt for a variety of reasons. However, Dodd-Frank has an exclusion if you are, well, Dodd-Frank is primarily, at least when it comes to this kind of stuff, is primarily focused on protecting owner occupants. I don't do these deals for owner occupants. I used to, I've done a couple, and I had to do the Dodd-Frank compliance thing. It was a pain in the butt, it wasn't worth it. So I only do these deals when I'm selling to investors. And I specifically, both in the purchase and sale agreement and in the note, I think we do it, make them confirm, or maybe at the closing, they confirm that they are not going to live in the property. Now that's the best I can do. I can't keep them from doing it. But if I suspect they're going to live in it, then I'm not selling it to them because I don't want Dodd-Frank to come bite me in the butt. And the people that I mean, someone who's in Australia isn't trying to live in this in a fourplex, right? They want this thing to be, they want the cash flow. They want to rent this thing out and generate that sweet, sweet cash flow. So I'm not worrying about that too much, but the answer to your question is yes. If you're selling to an owner occupant, you have to be compliant with Dodd-Frank. If you're selling to an entity that is not an owner occupied, that's not going to occupy the property, then Dodd-Frank doesn't apply. So we only sell to entities. No one's allowed to do these. No one's allowed to do these deals with us in their personal name. You have to do it through an entity, and you also have to sign that you're not going to live in the property. So that's how we avoid Dodd-Frank. And in our case, again, people that we're selling these things to are other investors who are looking to do exactly what we would do, which is put tenants in there and collect the cash flow. So that was your first question. What's your next question?
Okay, the second question is, I'm just thinking about the buyer, the investors that, coming from overseas or whoever.
Yep.
So are they kind of have a lot of experience or sophisticated, because landlording is not that easy, and they are coming from a foreign land and they might have to hire a management company or whatever. So how sophisticated do they need to be? They cannot just buy a house or property and turn it.
Right.
That's my
so the good news
question.
is that it will vary, but the financing doesn't make it harder or easier. So if they're committed to being to owning property in the U.S., they absolutely should get a property management company. They absolutely should get some help setting all those systems up. And the way I operate the way I've done my wholesale transactions is I'm happy to help them do those things. I'm not a licensed agent, and in Georgia you can't manage someone else's property without being a licensed agent. Plus I wouldn't want to anyway. So in Georgia, I refer them to my favorite property management company, and I say, hey, you should work with these folks. And so all of the out-of-state and overseas investors that I've worked with, I've referred them to my favorite property manager in Georgia. They got the business, and I didn't ask them for a penny. I didn't pay them a penny either, but I didn't ask them for a penny. And the reason why I didn't ask them for a penny, I didn't need it, because the faster those folks can get their property up and running and generating income, the faster they're coming back to me to buy more. So it's in my best interest to get them up and running and successful so they can buy the next one. So if they're not sophisticated, I can help them get sophisticated. But if they get a good property manager, at least the one that I had, that they needed to buy well, and they needed to find a good property manager who knew what they were doing, and they were in good hands. And so that's typically how I address that. I think I found one. I'm looking for more great property managers here in Tulsa, but the job of a good property manager is to make this property start making money as quickly as possible, and to deliver consistent quality cash flow for the life of the property while managing and maintaining the integrity of the property. That's their job. And if they do that job well, then it frees the investor to do what they want to do, which is buy more and more and more. And there I am selling them more and more and more. So they don't have to be super sophisticated. They just have to have a willingness to do this, but their level of sophistication isn't any, I don't need them to be any more or less sophisticated than they would normally be for buying any deal, whether it's financed or not. So if they're coming to me asking for deals, at least I can offer them, hey, you don't have to spend your entire wad of money on one deal. Instead of blowing your entire $500,000 on a single property, how about you buy 5 properties for that same $500,000 at $100,000 each or whatever. So that's my contribution to the situation. I'm not in the business of teaching people how to be investors, but I can certainly, it's in my best interest to bring them deals that make sense, which is why I'm careful about running my numbers, and I run them conservatively, because if they don't make money, I'm out of business as a wholesaler. I make my business on repeat transactions. So if I sell you a lemon, that's the last deal I'm going to sell you. And I've just cut that branch off forever. So my best interest is to sell you a sweet deal. And what is it, 12%? That deal was a sweet deal. So that's a real deal, folks. I mean, obviously, I'm not going to give the details of that deal until we have it closed. But if I can get those terms, if I can get that seller to accept those terms, I could do 100 of those. I could sell that deal in the next 24 hours at $200,000 all in and 12% cash on cash. I could sell 100. If I had 100 of those deals, I could sell 100 of those in the next 24 hours. So I don't need you to be super sophisticated as an investor. I just need you to want cash flow and be willing and be coachable into how to get this thing going right. You notice that I put management into my calculations. As those of you who've done the deal confidence know, should be there. Management is a real expense, whether you quote unquote do it yourself or not. So there's room in this deal for 10% management fee. So this is a conservatively underwritten deal because I want them to get management. I don't want them trying to manage a US property from Singapore or Australia. It's you get 5 time zones. I mean, are you really going to try to manage a property when it's, nighttime there and daytime here? No, it's a nightmare. Hire yourself a local property manager. The deal already covers it. It's still 12%. Even with that expense, it's still 12% and $1,700 in monthly cash flow. So yeah, that deal is a sweet deal for anybody. You could be a newbie investor and make money off that deal. And once you've made money off that deal, you're going to come back to me for more. And if I have more to sell you, then I'm your new best friend. Does that make sense?
Yes.
Good question.
So can I ask one more question?
Sure.
My last question would be, how do we find the sellers?
So I'm on
The marketing side.
So I'm gonna propose that I'm gonna answer that with the same way I answered this previously, which is that it's not that you find these sellers. Whenever you find a seller, you ask the question. You try to get to the answer to the question. What are they going to do with the funds? If they have specific and precise goals, aims for the funds, I'm going to pay my medical bills off, and then I'm going to buy my daughter a car. And then if they've got specific goals and every penny is accounted for, then you're probably not going to get seller financing because they need all that money to do something with. But if they don't have a specific plan for it, and most of these folks do not, then you should be asking the question, would it help you, Mr. Seller, if we presented you with an arrangement that would allow you to get paid upfront a reasonable amount at closing and an income stream over the next, say, 5 to 10 years? Would that be something that would be beneficial to you? And if they say, that sounds interesting, show me what you got, your foot's in the door and off you go. If they go, no, I need all my money right now, then you're likely not going to get a seller finance deal out of them. But that you don't, there's no this person you seller finance, this person you don't. It's based on the needs and the situation of the seller. They will tell you, if you ask them, whether they are suitable for seller financing. But I can tell you that the vast majority of investors don't even ask the question. They assume incorrectly that every seller wants all their cash up front, and that's just not true. It's absolutely false. For some sellers, they'd be far better served with an income stream over time. Some people know themselves. They know that if they get $1 million up front, they're going to blow it on, vodka and lottery tickets. And so for them, they may actually prefer the idea of getting an income stream over time to replace that what they used to be getting as rents. So it's not your job to figure out why they need it. It's your job to ask them if this is something that might help them. If they say yes, then you will structure the offer and present it to them. And then they can decide for themselves if that works or not. I do want to get to the question that someone had about sub 2. I did not cover, whoever it was it Nisha? I didn't cover subject 2. I'm sorry?
I'm sorry I'm sorry, I had a call, but yeah, I was going to ask you about that. If I'm buying it subject to, how do you feel about seller finance in that situation, wrapping it?
I love it. We've wrapped many a subject to deal. Subject to is its own animal, but it is a flavor of seller financing. And subject to, for those of you who aren't familiar with it, answers the question, what if you want to do what I just described, but the seller has a mortgage already? Can they sell you the property with that mortgage intact? And the answer is yes. if they choose to. How they do it, again, that's a course. It's literally a course on how to do that. Because subject to, while the concept is straightforward, the mechanics of it are not. And
Yes.
if you do it wrong, it can be devastating for you and for the seller. And I've learned this from firsthand experience. We've done dozens and dozens and dozens of subject to deals. And so, yes, it can be done this way. It is, I mean, I obviously prefer it if there's no debt because it's just cleaner. But if there's debt on there and you can, and the seller is willing to let you take that over, that can be an awesome deal because it frees them from the obligation, or at least from the responsibility of making that payment. And it gives you the ability to wrap that financing and map that payment into the payment that you're receiving from your investor buyer. So yes, seller subject to, another powerful strategy. It is a subset of what we're talking about here. It's a bit more complicated, a bit more sophisticated, but works like a charm.
And there's probably going to be a lot of them coming with these foreclosures.
Oh, yeah. And here's the cool thing. How cool will it be? I mean, think of all those beautiful 30-year, 3%, 4% fixed rate mortgages that are sitting out there. That I'm drooling over those because, I mean, and this is exactly what happened in the 70s and 80s, and the Jack Millers and the John Schaubs and all those titans of real estate that did this stuff in the 70s and 80s. That's exactly how they crushed the market, because they grabbed all the cheap financing and they subject to it and seller financed their way into wonderful things. So yes, and so for those of you who aren't getting what we're saying, I say for now at least, don't sweat it. Focus on just the concept of seller financing. There are many, many, many landlords that we're talking to who own their portfolio free and clear. So you don't have to worry about subject to until you come across somebody who has a mortgage. But a lot of these folks, they've been doing it long enough that they paid off their mortgage. And so they're sitting on a big bundle of cash with no debt. And if you discover that's the case, then you should be, it's a crime in my opinion to not make a seller financed offer to a seller unless they specifically told you that they have an itemized list of what they're going to do with the money, with the proceeds. If they haven't given you that, then it is, in my opinion, your responsibility as an investor to at least try to get them to consider taking payments over time. Last slide. I know that, I did promise I would cover this. So I'll just throw this out there. One of the titans, one of my mentors, a guy whose course I have like 4 or 5 of his courses, there's a guy named Dykes Boddiford, D-Y-C-H-E-S B-O-D-D-I-F-O-R-D. It's an unusual name. So if you put in Dykes or Boddiford into Google, you'll find him. He has a course on, I think it's creative financing techniques. And he talks about subject to, he talks about specifically and seller financing and the paperwork for those. It's relatively speaking. He's not one of those people who's getting most of their money from courses. He's an actual investor. So his courses, except that I'm a slow typist. Let's see if I can do type real fast. I think the course is like $400. It's a steal at 10 times the price. It's a steal. It is what I use. I cannot type and talk at the same time. B-O-D-D-I-F-O-R-D. There he is. Dykes Boddiford. Anything that he has to say, or Pete Fortunato, or any of the guys, those old school guys that I mentioned that are still around, or their stuff, if their stuff is still around, the Jack Millers and I can't think of the other guy's name, but there's that crowd. Anything that they have to say is worth listening to.
I was going to say I'm sorry for interrupting you. I was going to say there's the Pace Morby. That's the new one now. He has a sub 2 mentorship. I'm in it. You can always reach out to any of us and we'll help through the creative finance page on Facebook.
There are tons of folks who are doing subject to. It's an incredibly powerful technique. It is, it's easy to get wrong. So just be very, very careful and make sure that you understand your paperwork. And then we'll throw out a reminder for those of you who are in the Dual Confidence group. Congratulations. For those of you who want to be part of calls like this, we do these every 2 weeks. We talk about, actually this deal that I showed, the $1 million deal, is actually a joint venture deal that we're hoping to try to get under contract this week if we can all get it done. But this is what we talk about. These are the kinds of things we do. At very least, if you're on this call and you're not part of the Deal Confidence Skillset training group, I recommend that you join that group. It is, it's not the biggest group on Facebook. I don't aspire to be the biggest, but it is a group of serious, focused investors who are trying to get deals done and help each other do bigger, better deals. There is no hardcore selling of product. There is no Bitcoin. There is no puppies and kittens. It is just real estate and support of people. We also don't tolerate, people tearing each other down and nastiness. And if you do that, you're out of there. And so it's intended for the sole purpose of helping each other get better, smarter, faster, do better deals. And so if you are interested in that, if you Google search on real estate investor Skillset, it's a mouthful, real estate investor Skillset training group, or investor Skillset training, or if you find me, Mitch Messer, my profile has links to that page. There's no cost to join the group. All we ask is that you contribute and answer questions and offer resources where you can. But that's all I got. So I thank you all for participating and for your attention. I know it's a lot of stuff. My plan for this one, since this was a publicly available Zoom call, is I will be at some point getting this up on our YouTube page, so it'll be available for those of you who want to see the replay, because I know I covered a lot of this up quickly. My pleasure. Thanks, Ed, for attending. Thank you all for being here. And I am eager to see those of you who are in the group or joining the group who have seller finance deals that you want to talk about. I'm open to joint venture deals with everybody. That's what I do. And so if you are looking at a seller finance deal or seller finance possible or capable deal, and you want to talk about the mechanics, then jump in the group and let's talk about it. All right, folks, I have enjoyed this very much. Hopefully you did as well. Thank you all for attending. And I think with that, I will let you all enjoy your Thursday evening, and I will continue fasting. I don't even get a chance to eat. I don't eat until Saturday, but I thank you all. Thanks, folks.
Thank you, Mitch.
Take care.
All right. Have a good one.
You too.